This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the end of our previous session together, I left you to finish off example 6 there in chapter 6. What it involved was dealing with, amongst other things, the capital allowances available in the opening years of a new unincorporated trade. Now, we talked through how you go about that, and we determined, of course, as ever on a capital allowances computation, that the first thing that you deal with in relation to setting up the computation for what, of course, is the accounting period. Here, that opening period through to the 5th of April 17, we'll deal with the additions that rank for AIA. We'd identified which they were, the recording equipment and the computer equipment. Now, that therefore meant that we could use a little AIA working column. Again, you can just put the pound sign in as we've done there, or put AIA, or if it was relevant, remember, AIA stroke FYA, because it's in that little working column that you list out any assets that you acquired, any plant and machinery purchased during the period, that here will attract the availability of AIA, and were it relevant, of course, later on, any of the low emission cars that would attract first year allowance. So we've listed those out, and of course with 9-month period, as is the case for this new business, 9/12 of £200,000 would be £150,000 maximum AIA. Not a problem here. We've only got 32,600 of qualifying expenditure. So that therefore takes us across to our allowances column, again set up for this purpose. We'll also recognise that because we bought a motor car with emissions there between 76 and 130 grams per kilometre, that, and without private use by the proprietor, that goes into the main pool. So we need a main pool column as well, and the expenditure goes in there. The other car, of course, with rather higher emissions, and rightly therefore kept for the proprietor himself or herself, as the case was in this particular example, that has got some private use. Therefore, we set up its own separate column here, identifying the amount of business use that applied to it. So we allocate our expenditure now to the relevant columns. We're using AIA stroke FYA column, pretty routine in terms of most of the examples of any substance that you'll have to deal with. Main pool, obviously as it's a new business, there's no tax written down values brought forward here, and the main pool does get used, not because additions exceed the AIA limit, which would be another reason for it, but of course here because we've got the motor car being purchased. The other car, with the private use by the proprietor, got its own column. We've done the AIA, now the writing down allowance. For the writing down allowances, of course, 18% and 8% respectively because of the difference in CO2 emissions there, but also then critically time apportioned. The opening accounting period was 9 months, therefore 9 months worth of allowance. Don't make the mistake, as I've seen over the years many students do, of time apportioning the writing down allowance based on when within the period the asset, the car, happened to be purchased. Not an issue. What is relevant here is not when the particular car was purchased, whether that was the first day, 1st of July 16, or the last day, 5th of April 17. All that matters in this time apportionment is the length of that opening accounting period. It is 9 months, so irrespective of the date of purchase within that basis period, it's 9 months worth of allowance. So we calculate the 9 months worth of allowance. All of the 14.4 there available in relation to the main pool car, and transfers across, as did the AIA, to the allowances column. Then in relation, of course, to the business stroke private use asset used by the proprietor here, work out the 9 months worth of allowance, that is 888, so always establish what the full allowance would otherwise have been, and then restrict to the business use percentage, here 60%. And that figure transfers across into our allowances column. What we've done, of course, as well we know, we've reduced the expenditure of 14.8 by £888, but only got to claim £533 in the form of capital allowances there. So you've lost a portion attributable to private use. You've lost a portion of that expenditure from ever being available for capital allowances. So do you remember, when dealing with a full written response like this, to deduct the full 888 in the private use asset column, and then just to put the claim in for the business use element. So that, when we add it up, should give us the figure of capital allowances for the accounting period. That feeds back into a little working here to establish the tax-adjusted trading profit of the business for the period that we can then use to determine our assessments for the relevant tax year, as it is here, or tax years, as it may be in another examination question. They gave us the adjusted profit, that was 89,000. That, of course, in another question could be an exercise for you to do. Adjustment of profits as per Chapter 4. We've done the capital allowances as per Chapter 5, and with that extra bit of information given to us now within Chapter 6. It gives us a trading income assessment of 54,463. What we've therefore now got to do is to establish what, if I can get this to move down, there we go, what the actual assessment will be for the tax year. Now, this is made easier because of the choice of accounting date. We see that we started to trade on the 1st of July, and very kindly, we established the 5th of April as our accounting date. It means that 2016-17 is our first tax year. The basis of assessment in the first tax year is actual. The basis period is the start date through to the following 5th of April, and we now know for that period that we've got a tax-adjusted trading profit of 54,463. If, for example, these accounts have been prepared for a full year, then we wouldn't have had the problem with the capital allowances, but you would now have had to have apportioned that tax-adjusted trading profit to establish what amount of the accounting period's tax-adjusted trading profit belonged to this tax year, using your actual basis of assessment, as it is the first tax year of trading. But we've now got that figure, 54,463, and that then, in turn, feeds back into it. This would made this example a little bit more interesting than some of the others, because we now relate it back to the work that we did in Chapter 2, where we had to put together the income tax computation. So, in therefore to the income tax computation goes the tax-adjusted trading profit. Now again, it's a relatively brief and shortened version of that computation here, more than acceptable, by the way, in terms of an exam question. We're doing the income tax computation for 16-17. We'd also put in the name of the taxpayer there for whom we're doing it. Trading profit, as you know, is non-savings income. We've also got 3 months worth of the salary. 3 months worth of 40,000 is 10,000. Unemployment income is also non-savings. So all the income of the taxpayer for this tax year is non-savings income. Take away your personal allowance, you've got your taxable income. As it is all non-savings, it's very easy to calculate the tax. Up to 32,000 here, the normal basic rate band, no extension thereof, given the transactions that we know to have happened. 32,000 at 20%, and the balance then of the 53,463 into higher rate band, and that is taxed at 40%, thus giving us our income tax liability. So again, typical example of what you could see in relation either to the Section C question, where we guaranteed a 15-mark income tax question, where a little bit of adjustment of profit may be involved, a little bit of, as we've seen, capital allowances may be involved, and then rather than stopping at having got the tax-adjusted trading profit, use it to establish an assessment for our tax year 16-17, and then to include it within that income tax computation, along with any other sources of taxable income that the taxpayer may have for that tax year, and based on that taxable income, then to proceed to compute the income tax computation. So bringing together elements of business and personal tax, as it were there, what we did in Chapter 2, what we've done in Chapter 4, what we've done in Chapter 5, what we've done in Chapter 6, and of course it might even be a bit of Chapter 3 if there was a property income assessment thrown into that as well. All leading to either a 15-mark question, or it'd be broken down in terms of a Section B 10-mark question into 5 separate objective testing exercises. So all of those were eminently examinable. Any part of this, of course, again, eminently examinable in terms of a Section A question. Okay, let's return now to the chapter. And the final bit as regards the closing years rules that we need to look at was what happens on cessation of trading. Now this again from your work in Chapter 5, our work indeed in Chapter 5 there, you should know how to deal with a cessation of trading and the capital allowances computation that is prepared for the final period of trading for that business. We know there's no writing down allowance, no AIA, no FYA. The only allowances that would be available in that final period is a balancing allowance. So what we've got to do is to work out a balancing adjustment here, which of course would be a balancing allowance if the proceeds on the sale of all those assets, if those proceeds were less than the tax written down value. On the other hand, if the proceeds were more than the tax written down value, then a balancing charge would arise. What do you do with those figures? Well, a balancing allowance is just the normal capital allowance for that particular, it happens to be the final period of trading, and you take it away from the adjusted profit there in establishing the tax adjusted trading profit figure. If it were a net balancing charge that arose in relation to the capital allowance computation for that final period of trading, then rather than deducting, you would add back that balancing charge to the adjusted trading profit to give you an even larger tax adjusted trading profit. So deduct the capital allowances, deduct any balancing allowance as your capital allowances, add in any balancing charge to determine the tax adjusted trading profit figure. As we know, if we were putting this computation together, therefore, how we derive that balancing adjustment, we pick up any tax written down values brought forward. We would, if there were additions in the period, add them to the relevant pool. Then the disposal proceeds would be deducted. Remember, when you deduct proceeds to a maximum, of course, of original cost, they would be deducted to find a balance. As we've just said, if the net balance is still positive, then a balancing allowance will arise because the proceeds are less than tax written down value. Whereas if the net balance is a negative, because the proceeds were bigger than the tax written down value, that's a balancing charge. Balancing allowance, deduct from adjusted profit, balancing charge, add to adjusted profit, and there you've got your tax adjusted trading profit for that final period. That then, as we've just been seeing with an opening year's example, that tax adjusted trading profit figure for the final period would be used in determining the assessment for the final tax year of trading. And the exercise then would be complete. So far as the capital allowances computation is concerned in such a problem, you may recall, but if you look back to Chapter 5 and example 5 therein, you'll see a little capital allowances computation as regards the period of cessation of trading. So you can go back and remind yourself of the issues there. Okay, now that sorts out the major issue for this chapter, which is how do we work out assessments here for our unincorporated trade from the very first tax year all the way through to the very final tax year. Well, we've got one final bit to deal with here, and it's referred to, as you can see here in your note on section 3, as being the cash basis for small businesses. Right. We're now going to talk a little bit about accounting and its involvement in terms of our tax computations. Now, don't worry, nothing frightening about this. In terms of accounting, you know that you prepare your profit and loss account or statement of profit or loss, whatever you want to call it now. But we use an accruals basis. We don't use a cash basis, we use an accruals basis. And that, therefore, is a tricky concept sometimes for traders who are non-accountants to actually get into their heads. So it often means that, therefore, they need to get an accountant, not a bad idea, by the way, to prepare their accounts for them, and that's more expense, more cost being incurred by these small businesses. Now, it's not only these small business traders who seem to have a problem with the accruals basis. From some of the questions I've seen on Ask the Tutor, they're not the only ones who have problems. Make sure you remind yourself of your, again, financial reporting, financial accounting work. So the only reason why these accounts were being prepared by an unincorporated trader using the traditional accruals concept there would primarily be for tax. Okay, accounts may be needed for banks and other financial institutions if you wanted to borrow money, but for small unincorporated traders, really the only main use is for tax. So very kindly, lovely people as they are at HMRC, they brought in a few years ago a cash basis, which meant that for tax purposes, you don't have to prepare accounts using your normal accruals basis. We can instead simplify and just use a receipts and payments basis. Now, there's one or two complications in this, but it makes it a whole lot easier for the trader to have accounts prepared and a whole lot more understandable so far as they are concerned if we work on a receipts and payments rather than on an accruals basis. So how does this cash basis work, therefore, and for whom is it available? Well, it's already said there for small businesses. Now we can define these. Now note again, small unincorporated businesses here. This is not available to companies. Insofar as corporate tax companies are concerned, incorporated traders, they've got to do it right. If you go down the incorporated route, there's no cash basis for you, it's accruals basis. We prepare the statement of profit or loss on the normal accruals basis. We then adjust that up, given what we've done in Chapter 4, and we do our capital allowances as we've dealt with in Chapter 5. Okay, unincorporated businesses, remember, sole traders and partnerships. They may elect to use a cash basis to determine their tax-adjusted trading profits instead of the normal accruals basis. Now, first issue, who is eligible for this? We know it's unincorporated. What do we mean by small? Well, the answer to that question, with receipts for a 12-month accounting period here, assessable in the tax year, that do not exceed the VAT registration limit of £83,000. So there's your level of turnover, your level of sales here, the level of the happens to be the VAT registration limit there, something we'll talk about more in the VAT chapter right towards the end of this particular set of notes on the course. So it's a small, so your sales there, the cash basis, the receipts that you're talking about do not exceed those level of £83,000 and you're unincorporated. That business may be small to begin with, but of course its receipts may increase. And if you get to the stage where, if receipts assessable in the previous tax year exceed twice the VAT registration limit, currently 2 times 83 is therefore 166,000 therefore, then they would be required to leave the cash basis and would have to go to the normal accruals basis of preparing their accounts. Assuming, and you'll be told in a question if the receipts basis is to be used, if it is applicable, you won't be left in any doubt. If they want the receipts basis, they will tell you that the receipts basis is required and is to be used. The cash basis will assess a business on its cash receipts, quite obviously, less cash payments. So it's not the sales less the cost of sales. It is receipts less payments. Again, those payments are allowable business expenses. Again, we're talking about what would be allowable for taxation as a business expense. Still, adjustment of profit issues apply. But your payables, receivables, inventory ignored. or as I would have called it in the good old days, your creditors, debtors and stock there are all ignored. We just want cash, receipts and payments. The accounting profit must, as we've said, be adjusted for taxation for taxation purposes, mostly again as for accruals counting, but with the main difference being in relation to capital expenditure. Now we know up until this point in time, where there is capital expenditure, we would disallow in the adjustment of trading profit. We only allow revenue expenses against trading profits, and then separately consider within our capital allowances computation whether the capital expenditure incurred in the basis period, in the accounting period, does that represent qualifying plant and machinery. If it does, then that feeds into the capital allowances computation. But what happens here? Expenditure on plant and machinery, which would normally attract capital allowances, as we said, will now attract tax relief with capital payments. Again, we go to a payments basis for plant and machinery, except cars. Isn't it always the way? When we looked at capital allowances, which asset gave us the most trouble and probably the most involvement in terms of an exam question? The purchase of cars. Cars, of course, we had to look at their CO2 emissions to know whether we got writing down allowance and whether it was 8% or 18%, or whether we got first year allowance if we were talking about low emission cars. And if any asset was likely to have private use by the proprietor, that was the one. So cars were a real pain, much as they are indeed in real life. I speak from experience there. That particular issue is still a problem here. So everything else, just your normal plant and machinery, payments for plant and machinery will be deductible. And when you sell old plant and machinery, capital receipts from sale of plant and machinery will be taxable. So, to repeat, the expenditure on plant and machinery will attract tax relief with your payments being deductions and your receipts coming in there as income. That will go in. Again, though, except cars. And that will be included in your calculation of the adjusted trading profit. So to begin with, separating out cars for one moment, life again is easy. We are on a receipts and payments basis as we would be with our normal sales and purchases and expenses. We don't work accruals, we work receipts and payments. But what do we do in relation to cars? Well, there's a choice. In respect of cars, says instead of claiming capital allowances, so that is still an option. But to make it easier, so we don't have to get involved in the capital allowances system, the trader may instead use a fixed or flat rate deduction for tax purposes. How does this work? The actual capital cost of acquiring a car for use in the business, the running costs year on year, and the eventual proceeds when sold are excluded from the profit calculation. So when we buy, when we sell, in between the running expenses, the payments, the receipts are not there, going to go through our calculation of profit. But instead, we do get a deduction in relation to the business mileage for which we have used that car. It works this way. The trader can instead claim as a deduction against that trading profit what we call a mileage allowance for the business mileage. So again, we need to know, and you'll be told, what is the business mileage. The allowance is a rate of 45 pence per mile for the first 10,000 business miles and 25 pence thereafter. Now, these are figures that actually are not just used here, but are also relevant when we deal in Chapter 9 with employment income. When an employee uses his or her own car for business purposes, they may be recompensed by their employer by a mileage rate. And these are the so-called authorised mileage allowance payments. First 10,000 business miles, 45 pence per mile, thereafter 25p. Now, as I said, We will see those when we deal with Chapter 9. Also, these figures of 45p and 25p there, they're actually provided to you on your fact sheet on your rates and allowances pages. So if you have a mental block and can't remember, you can look it up. They will be there. Now, again, in any question that we do, or that you're asked to do in terms of the cash basis, it will be this system that will be intended and required to be used in relation to how you get your tax relief using the mileage basis there. So how was it that we calculated our taxable trading profit? Receipts, including the sale of plant and machinery, as we have identified there. Expense payments, including purchase of plant and machinery, those that would be allowable for taxation, normal adjustment of profit rules as regards allowable and non-allowable expenses. Deduct those, and thus we get the tax adjusted trading profit. Now, as we're about to see in example 7 that now follows on, what we may have to do is to actually do two calculations here. Two calculations, one based on the normal accrual system and how you would work out the tax adjusted trading profit, and another comparative figure using the cash basis as a basis then of being able to advise the taxpayer which system would be best. So I need you now to read through the information in example 7. I'd like you to read that through, please. We probably would be a good idea to actually bring this session to an end, just looking at the timing on it so that the file isn't too big. So what I'll ask you to do, read through that information, familiarise yourself with it, have a think about how we would satisfy these particular goals of calculating Adam's adjusted trading profit for the accounting period ended 31st of May 17 using the normal basis and also using the cash basis. Now this is going to involve, certainly on the normal basis, a little bit of financial reporting work, but of course tempered with using the taxation rules. But you do need to know how you would calculate profit, for example, sales less the cost of those sales. I do hope you remember that. But have a go at putting together, therefore, the calculations of the adjusted profit using the normal accrual system and then using the cash basis of receipts and payments. And I will run you through the answer to that and explain it when you start again with our next session together. In that next session, we will then finish off this example and the final few little bits and pieces that need to be done. But you have a go at that before I see you next. I look forward to seeing you to what then will definitely be the final and hopefully quite short final session on this chapter.